How would you think about a deal that gives you a return of 15%, but with a risk-adjusted return of negative 30%, and where, if things go wrong, you stand to lose 41% of your capital? It's an odd one, right? Well, today we're looking at the $4.25 billion takeover of the delivery app Just Eat Takeaway and what it means for investors. Takeaway.com was founded in the Netherlands in 2000 as one of the world's first delivery platforms. It expanded quickly across Europe, and in 2020 purchased British rival Just Eat. This was followed by the acquisition of GrubHub in 2021. The various lockdowns in 2020 and 2021 led to a huge boom in business and changed many customers' ordering behaviors. However, with slowing growth post-lockdown, coupled with a cost of living crisis, which have hindered the growth prospects, the company has struggled over the last couple of years. Earlier this year, Takeaway retreated from the American market by selling GrubHub for $650 million, but only received net proceeds of $50 million when debt was taken into account. Not exactly the best return on the $7.3 billion Takeaway paid for the company just 3 years ago. And now Takeaway.com is itself on the menu. The company has agreed to be bought for $4 billion by Proces, a Dutch technology investment fund. The deal has been agreed by the directors of both companies and now requires shareholder and regulatory approval before it can close. So, what about the numbers? What does this deal offer to an interested arbitrager? If you were to take a long position in Takeaway.com today at a price of €19.10 per share and wait for the deal to close later this year at €20.30 per share in cash, you could expect to generate a return of 6.28%, which equates to 15.39% on an annualized basis. However, the risk-adjusted return falls to negative 13.31%. This is because there is a 75% probability of the deal closing, with a straight 6.28% return, against a 25% chance of the deal failing, with an expected loss of 40.58% should the share price fall back to its pre-takeover value. Now, if you were an avid participant in the takeover world, and you were able to move as soon as this takeover was announced, you would only have paid €12.57 for each Takeaway.com share. Let's see what that would have done to your returns. The expected return now increases to 61.5%, or 150.64% on an annualized basis, which is quite spectacular as far as these things go. The risk-adjusted return also increases significantly to 107%, in no small part due to the small loss should the deal fall apart, which now stands at 9.71%. We can clearly see times of the essence in a deal such as this. So, what does everyone think of this deal? Let me know in the comments below, and don't forget to like and follow if you found the video useful. Be aware that all the figures mentioned are at the date of my calculations and will change in line with the share price, any changes to the deal terms, and the duration to close. As always, this information is provided for educational purposes only. You should not consider anything in this video to be investment or financial advice, nor a recommendation or endorsement to buy or sell any financial instrument. You should always conduct your own research before considering any investment and seek independent financial advice. Thank you for joining me today, and until next time, have a great day.